One of the biggest misconceptions banks want us to believe is that our money grows when it's kept in a bank account. While the number in your account may increase due to interest, its actual value often doesn't keep up with inflation. With the cost of living rising rapidly and bank interest rates lagging behind, keeping your cash in the bank can actually erode your wealth. In this video, we'll reveal 7 assets that are better and safer than cash, helping you to protect and grow your wealth. 1. Precious metals: gold, silver, and platinum. Precious metals, like gold, silver, and platinum, are often referred to as God's money. These metals are valuable because they are scarce and can't be easily created. Unlike paper currency, which can be printed in unlimited quantities by governments, precious metals retain their value over time. One of the key reasons precious metals are so valuable is their limited supply. Governments can print more money, but they cannot simply create more gold, silver, or platinum. This scarcity gives these metals their enduring value. For instance, before the 1950s, an ounce of gold cost around $400. Today, that same ounce is worth over $2,000. Experts predict it could rise to $10,000 by 2032. This makes gold a reliable store of value over time. The price of gold has seen a steady increase, currently standing at around $2,250 per ounce. Silver is trading at approximately $29 per ounce, and platinum at $1,050 per ounce. These metals are not just about historical value, they continue to be relevant today. Investing in precious metals is a strategy that has been used by the wealthy for generations. It's not just about owning physical gold bars or coins, although many people do prefer that. Nowadays, there are various ways to invest in precious metals. One popular method is through gold ETFs. These exchange-traded funds track the price of gold and offer an affordable way to invest in the metal without having to store physical gold. This can be a more convenient option for many investors. Silver and platinum also have their own unique advantages. Silver is not only a precious metal, but also an industrial commodity used in electronics, medical equipment, and more. This dual demand can help support its price even during economic downturns. Platinum, though less well known than gold or silver, is equally valuable and is widely used in the automotive industry, particularly in catalytic converters. 2. Industrial commodities: raw materials moving on from precious metals. Let's talk about industrial commodities. Industrial commodities like silver, cobalt, nickel, and copper have high utility and demand in various industries. These metals are crucial for many modern technologies and infrastructure projects. For example, silver is used in electronics, medical equipment, and nuclear reactors. Cobalt is essential for electric vehicle batteries, and its price has doubled in the past decade. The industrial demand for these materials ensures that their value remains high. Cobalt, for instance, has seen its demand skyrocket due to the electric vehicle revolution. As more countries push for greener energy solutions and electric cars become more popular, the demand for cobalt, which is used in lithium-ion batteries, will continue to rise. This demand has already driven prices from $20,000 per ton in 2012 to $40,000 per ton in 2022, and cobalt prices are now around $50,000 per ton. Copper is another essential commodity. It is used extensively in construction, electronics, and power generation and transmission. As developing countries continue to urbanize and developed countries upgrade their infrastructure, the demand for copper remains strong. Copper is trading at about $4.70 per pound. Nickel, used in stainless steel and batteries, also benefits from the ongoing industrial activities worldwide, with current prices at around $18,000 per ton. Investing in stocks of mining companies, mutual funds focused on mining, or derivatives like futures and options can provide exposure to these valuable raw materials. Companies like Rio Tinto and BHP Billiton are major players in the mining industry and offer stocks that can be part of a diversified portfolio. Mining-focused mutual funds and ETFs are also available. providing a more straightforward way to gain exposure to these commodities without needing to invest directly in physical raw materials. 3. Safe haven currencies. After discussing precious metals and industrial commodities, let's look at safe haven currencies. In a world where fiat currencies aren't backed by gold, geopolitical stability is crucial for currency value. The Swiss franc is a prime example of a safe haven currency, offering stability and security during times of global turmoil. Switzerland is known for its strong economy and political neutrality, which makes its currency a safe bet when other currencies might be losing value. During crises like the Eurozone debt crisis in 2009 and the 2008 financial crisis, funds flowed into Switzerland to avoid devaluation. Superior currencies like the Swiss franc, British pound, and Chinese yuan are excellent stores of value. For instance, during the recent Russia-Ukraine crisis, the Swiss franc gained value as investors looked for safe havens. The Swiss franc continues to show strength, with an exchange rate of around 1.10 USD. The Swiss franc's value is also tied to Switzerland's robust banking sector. Swiss banks have a long-standing reputation for security and confidentiality, which attracts wealth from around the world. This influx of capital during times of crisis helps to support the franc's value. The British pound, while sometimes volatile, has historically been a strong currency due to the stability and size of the UK economy. The pound is currently trading at around 1.30 USD. The Chinese yuan is becoming increasingly important on the global stage as China continues to grow as an economic powerhouse, currently valued at around 0.15 USD. You can gain exposure to these currencies through currency ETFs and forex brokers. Currency ETFs are an easy way to invest in foreign currencies without having to hold physical money. Forex brokers like forex.com, allow investors to trade currencies with relatively small initial investments. This makes it accessible even to smaller investors who want to diversify their portfolio with foreign currency exposure. 4. Government securities. Next, let's talk about government securities. Government securities like treasury bills, notes, and bonds are backed by the full faith and credit of the government, making them a secure investment. Since no strong government will default on its obligations, these securities are considered safe. They offer a reliable way to earn interest while preserving capital. Since 1971, when President Nixon abolished the gold standard, the dollar has been a fiat currency, meaning it's backed by the U.S. government's credit rather than a physical commodity like gold. This makes U.S. Treasury securities a reliable investment because they are backed by one of the world's strongest economies. In the U.S., you can invest in Treasury securities through the Treasury Direct portal or the secondary market. Treasury bills, T-bills, are short-term securities that mature in 1 year or less. Treasury notes, T-notes, are intermediate-term securities maturing in 2 to 10 years. Treasury bonds, T-bonds, are long-term securities that mature in 20 to 30 years. These investments offer better returns than keeping cash in the bank, providing both security and stability. The yield on a 10-year U.S. Treasury note is approximately 3.6%, reflecting a stable investment with moderate returns. Government bonds from other stable economies, such as Germany, Canada, and Japan, also offer secure investment opportunities. These bonds are less likely to default than corporate bonds and can provide a steady income stream. However, it's important to consider the credit rating of the issuing country, as this can affect the risk and return of the investment. 5. Value stocks and mutual funds. Now, let's shift our focus to value stocks and mutual funds. While Treasury investments are secure, they often offer lower returns compared to stocks. Value stocks, which represent established companies with strong fundamentals, are less risky and provide steady returns and dividends. Investing in value stocks can be a good way to achieve higher returns while still managing risk. The stock market is broadly divided into two types of stocks: growth stocks and value stocks. Growth stocks, such as technology companies, are riskier because they often deal in ideas and technologies that have a high failure potential. However, they can offer high returns if the company succeeds. On the other hand, value stocks are shares in companies that are well established with predictable revenue streams and strong balance sheets. These companies are typically leaders in their industries, such as consumer goods, healthcare, and utilities. Investing in dividend-focused mutual funds, like the Vanguard High Dividend Yield Index Fund, can be a great way for retail investors to achieve higher returns while minimizing risk. These funds invest in companies that have a history of paying dividends, providing a steady income stream. Mutual funds and ETFs offer diversification, reducing the risk of investing in individual stocks. The average dividend yield for value stocks is around 3.2%, making them an attractive option for income-focused investors. Researching the fundamentals of each value stock can be time-consuming. Mutual funds and ETFs simplify this process by allowing investors to gain exposure to a diversified portfolio of value stocks. This approach helps spread risk across multiple companies, industries, and sectors, providing more stability to the investment. 6. Real estate. Moving forward, let's explore real estate. Land and real estate have always been valuable assets because they are scarce and always in demand. From homes and schools to factories and commercial spaces, the need for land is constant. Real estate acts as an excellent hedge against inflation, as property values tend to rise over time. Real estate investment can take many forms. Buying residential properties, such as houses or apartments, can provide rental income and capital appreciation. Commercial real estate, including office buildings, retail spaces, and industrial properties, can offer higher returns, but also come with higher risks and management responsibilities. You don't need a lot of money to invest in real estate. Real estate investment trusts, REITs, like Ventus Inc., which focuses on healthcare real estate, offer a way to invest in real estate without owning physical property. REITs are companies that own, operate, or finance income-generating real estate. They are traded on major stock exchanges and provide a way to invest in real estate with the liquidity and ease of stock trading. REITs are providing an average annual return of around 8.2%, making them a competitive investment option. Owning rental properties is another option. Purchasing properties to rent out can generate a steady income stream. Rental income can cover expenses and mortgage payments, potentially providing positive cash flow. Over time, property values may appreciate, adding to the investment's return. 7. Cryptocurrencies. Lastly, let's dive into the world of cryptocurrencies. Cryptocurrencies have become increasingly popular as an alternative investment. Bitcoin, Ethereum, and other digital currencies offer the potential for high returns, although they come with higher risk due to their volatility. Cryptocurrencies operate on decentralized networks using blockchain technology, which provides security and transparency. Bitcoin, the first and most well-known cryptocurrency, has seen its value skyrocket over the past decade. From being virtually worthless in its early days, Bitcoin reached an all-time high of nearly $75,000 in 2024. While its price can be highly volatile, many investors view Bitcoin as a digital store of value, similar to gold. Bitcoin is trading around $55,000, reflecting both its volatility and its potential for significant returns. Ethereum, the second largest cryptocurrency by market capitalization, offers more than just a digital currency. Its blockchain technology supports smart contracts and decentralized applications, dApps, which have numerous real-world applications. This has made Ethereum a popular choice for investors looking to diversify their cryptocurrency holdings. Other cryptocurrencies, known as altcoins, also offer investment opportunities. Each has its own unique features and use cases, from privacy-focused coins like Monero to decentralized finance, DeFi tokens that enable new financial services. Investing in cryptocurrencies can be done through cryptocurrency exchanges. which allow users to buy, sell, and trade digital currencies. Some popular exchanges include Coinbase, Binance, and Kraken. Additionally, cryptocurrency wallets provide secure storage for digital assets. While cryptocurrencies can offer high returns, they are also highly speculative and can be risky. It's essential to do thorough research and understand the risks before investing in this asset class. Investing in these 7 assets can protect your wealth from inflation and provide better returns than keeping cash in the bank. Diversifying your investments into precious metals, industrial commodities, safe haven currencies, government securities, value stocks, real estate, and cryptocurrencies can help you build and preserve your wealth for generations to come. By spreading your investments across different asset classes, you can reduce risk and take advantage of various growth opportunities. Remember, it's always a good idea to consult with a financial advisor to tailor your investment strategy to your specific goals and risk tolerance. If you enjoyed learning about these valuable investment options, give us a thumbs up, subscribe for more insightful financial content, and share your thoughts in the comments below. Stay tuned for more wealth-building strategies, and until next time, keep investing wisely.